very excited to have this panel kicking off today. An all-star lineup with Caitlin, Jodie, and Susan. I'm super excited to be chatting to the three of you. For those who don't know me on the call, my name's Tila. I'm the AU Community and Partnership Specialist for Cake Equity. If you don't know us, we are the leading cap table management software for founders looking to accelerate team motivation through equity ownership. And jumping on today, we have Caitlin from Angard Consulting, Jodie from Tractor Ventures, and Susan from The Laundry Lady. And I feel like today's topic is super timely just from the point of view of, obviously the VC landscape is changing, and the way that the VC funding model works is really by this power law where when they are investing in startups, they're expecting like banking on that startup to be the one that returns the majority value back to their portfolio. And there's just tons of businesses that either don't have that kind of TAM or it's not the vision for the founders. So that's why I'm excited to chat about this stuff, because I think there's so many other ways that we can help these excellent startups still succeed and solve really meaningful problems. So this is why I've assembled this panel together, because these guys are experts. And I just want to let everyone know that's on the call right now. If you have any questions, I have enabled the Q&A button at the bottom of Zoom, so you can pop your question in there. And I believe that means that you're anonymous if you don't want to ask, but otherwise just pop it in the chat. And today we're just going to have like a real free-flowing conversation. Sharing ins and outs of all these different specialties. So I'll throw across to you, Caitlin, like if everyone just wants to do like quick little intro, who you are and what you love chatting about when it comes to alternative funding.
Yeah. So yes, my name's Caitlin. I have kind of three hats that I wear. One is running grants and fundraising for St John Ambulance Queensland, which is a Queensland-based charity and social enterprise. And then I do consulting through my business, and that is predominantly with a mixture of nonprofits, startups, and social enterprises. And then I also teach grant and tender writing at the University of Sydney. So I'm really all about grants and tenders, which is a very niche area to be all about. And the reason I'm quite passionate about grants and tenders is because I actually want to run myself out of a job. And when it comes down to it, is that people often come to me and they're like, "Oh, grants, free money, yay! Like, let's talk about it." And I want to really educate people around the fact that it's not free money. It's really time and resource intensive, and it's a really great solution if it is part of kind of a broad strategic plan and a diversified revenue strategy, but it is not a silver bullet. So that's kind of my thoughts.
I feel like it's kind of like free money, but I don't know, like maybe you'll help me with
I will absolutely help you
theory
with
that
that.
I have. And then Jodie.
Hi everyone, thanks for having me. So I'm CEO and co-founder of Tractor Ventures, and this is my third business. So very much identify as a founder, even though we are investors in this space. So we started in 2020, and we've now deployed over $100 million to over 250 founders across Australia and New Zealand. And we're industry agnostic, so it's across many different types of businesses. And often, as you say, Tila, like those founders that don't want to go on the rocket journey. So the reason we're called Tractor is we're not for the rockets. It's the opposite of the VC model, which rockets are exciting and some of them land on the moon, but they're also very expensive and a lot of them blow up along the way. And we've seen a lot of that in the years. I've been in this ecosystem now since 2011. So I've seen a lot of startups start and grow and also fail and break. And so that's why we wanted to bring this type of capital to the market. And I'm very passionate about talking about it, obviously. And I think the main thing is just educating founders that there are many types of capital and trying to work with founders on what's the best type of capital to use at what time, and for what purpose. So sometimes definitely you need to raise money for certain growth plans. Other times it's better to take on debt, and then other times if you can get some government grant funding also is great. So it's sort of having the mix and having that weighted average cost of capital worked out for your company at the right time is what I like to talk about.
Yeah, excellent. And then Susan.
Yeah, hi everyone. I identify as a founder too. So I'm CEO and founder of The Laundry Lady. We are a laundry service that will come and pick up your ironing and washing from your door and bring it back to you next day. And we service a range of homes and businesses. And what makes us really unique is that we service our customers through a team of independent contractors. They're our laundry ladies and lads, and they all work from their own home and use their own cars, their own washing machines. We have just over 400 of them throughout Australia and New Zealand, and 90% of them are women who we're supporting with a really flexible, sustainable income.
Amazing. And you've bootstrapped?
Bootstrapped, yes.
And also raised.
Extensively, and just very recently raised, but we've bootstrapped a very long time. So I have lots to share about that journey.
Yes, and I think you and I had the joy of catching up last week in Brisbane at Something Tech, and we were chatting about how Laundry Lady has capitalised on grants. You've had some non-dilutive funding as well as now having raised. So yeah, I'm super excited for you to add in like your founder shares through this conversation, because I feel like you've done it all, which is
We've done them all.
So good. All right. So kicking off with some basics, Caitlin, I'm going to start with you. Like grants, how do we find them?
Great question. In terms of how I find them, I have like a very like broad structure in terms of like, looking at government grant databases, signing up to a lot of newsletters. Like a lot of newsletters come into my inbox every single day. I'm at a point where a lot of people will send them to me as well, because I do a weekly grant wrap up on my LinkedIn to kind of like highlight some of like the good grants that have kind of been released. In terms of startup grants, you're really looking at the kind of startup departments in each of your states and territories. So each state and territory will have a department that kind of looks after your area. Might be Investment New South Wales, might be Launch Vic, might be Advanced Queensland for Queensland people, and they will kind of manage the grants that will particularly benefit startups. So in Queensland, we have the Ignite Ideas grant. New South Wales just relaunched their MVP grant. Federally, you can look at the Industry Growth Program one. So there's really only one federally, but you can always kind of keep an eye out for the relevant departments who will kind of like launch grants. If you go to, I think it's business.gov.au, that is kind of the broad federal government portal for all grants, but all states and territories put their grants into this portal as well. So you don't need to kind of go everywhere. If you kind of want one central portal, that's a portal I visit fairly regularly. So you can kind of sign up for newsletters from your kind of local startup departments. There will also be grants that are released from your local councils and maybe departments that sit a little bit outside of the startup space. So it might be a department of small business. So it's just important to kind of have a think about where you kind of need grants. Like, is it equipment? Is it really growing your business? And then have a look at kind of your state and territory departments and kind of which ones might be relevant to you, because definitely not all of them are going to be relevant, but there will be kind of your core startup department, and then it will be maybe Department of Small Business, Department of Sciences, just however your state and territory is set up, because everyone is set up very differently. And then it is the Department of Industry and Resources, really, on a federal level, that do the Industry Growth Program. So yeah, lots of different places.
And periodically, like I feel like I've seen online in some of the newsletters that I've subscribed to, there's like private companies that offer grants as well.
Yeah, that is, I guess, like a little less relevant to startups, because some of them, there will be a small percentage that are applicable to kind of for-profit businesses. Many of them target non-profits because it is part of their kind of corporate social responsibility plan. But there is the odd case where you will get them targeted towards startups because they're particularly interested in innovation and social enterprises. So if you are a startup social enterprise, that is a very good space to be in at the moment, because there is a lot of kind of procurement preferences around startups and particularly social enterprise if you're a registered social enterprise. But yeah, so I know that there are organizations like Coles, for example. If you're in ag tech, Coles do like an annual kind of ag tech grant. Xero do an annual grant for kind of innovative businesses. Yeah, so there are some kind of corporates out there that will do suitable grants, and they will be kind of anywhere between kind of $5,000 to $50,000.
Yeah, cool. And then in terms of like how when you've like found the one that you want, like you touched a little bit on this, and like I'm sort of in two minds here whether to jump to Jodie and chat about non-dilutive funding, but I'm sort of also a bit intrigued about the going to the question of like, you've mentioned that some grants aren't for startups. Like, so how do you know like which grants are for you?
Yeah, it'll be really clear in the eligibility criteria. So when you check the eligibility criteria, it will say, pretty standard kind of eligibility criteria. Do you have an ABN? That kind of stuff. But if it is for a nonprofit, it will very clearly say, and often it will say, do you have DGR status? So DGR status is deductible gift recipient status, and that is essentially a very specialized form of tax status that you can get when you're a charity. That means that any gift I give to a charity, I can claim it on my tax. And so that will typically be in your eligibility criteria. So if that is in there, it is not for you. If it is for social enterprises, it will sometimes, I would say 95% of the time now, because it has increased, we'll ask if you are social traders certified. So social traders is typically the acceptable certification to demonstrate that you are a legitimate vetted social enterprise. And you will have to provide your kind of certification. But apart from kind of those two, you'll just be able to kind of see in the eligibility criteria. If it doesn't specifically exclude you, then that you can look further into the grant as to whether it fits your specific project. Because I want to be clear that eligibility criteria is one thing, and then assessment criteria is a different thing. Just because you're eligible doesn't mean you're a good fit. So those are kind of like, once you know you're eligible, check out the assessment criteria and make sure you're a good fit.
Yeah, excellent. All right, so moving, to Jodie. Would love to know a bit more. You touched on like some of the stuff that Tractor doesn't do, in that you guys are for tractors, not for rocket ships.
Yes.
But tell me a bit more about like what is non-dilutive funding? Like, what are our options if we're not going to VC? And yeah, who does Tractor work with?
Yeah. So non-dilutive funding in our view is pretty much debt. And so think of it as a business loan. And we've evolved our products over time and recently launched a few new ones. So we do a basic term loan, and that can be from 3 months to 5 years. And we lend between $100,000 and $3 million, depending on what revenue you're doing and what your needs are. We do a line of credit, which our customers have been asking for the whole 5 years that we've been going. But as a non-bank lender, it's been hard for us to figure out how we lend you money that you don't take yet. But we have figured it out, which is great. So now we can do a line of credit where you only need to draw 25% of the amount that we allocate for you. So for example, you could lend $1 million and you only have to pull down $250,000 and be using that. But then you have the security and the peace of mind that you've got this extra money there that you can pull on when cash flow gets bumpy. And there's just a small line fee on that remaining amount. And then we've also started to do R&D finance. So if you're doing R&D and you're applying for that grant, then we can lend against that as well, which basically just means you get access to the money before the refund comes in, because ATO has been slow at refunds and there's a lag. And so if you know you've got some things that you want to do, instead of waiting for that return, you can just start using the money straight away. We also do like an inventory advance too. So if you're buying inventory or your manufacturing inventory, we can lend against that workflow as well. And so, as I mentioned, like it's across many different types of industries and companies. So we work with e-commerce, we work with course, B2B SaaS, but also manufacturing companies. We work with even service companies like recruitment agencies and marketing agencies. So as long as there's some sort of, we talk about tech enabled, and what we're looking for is some sort of ability to scale and to
Yeah.
sort of get a growth happening. Because that's when you've got that growth and you've got that ability to scale, then you're more likely to be able to easily repay this money. Yeah.
Yeah, excellent. And when it comes to the R&D portion of the lending, like, is that still similar in terms of like, has like an interest portion that they've got to pay on top of what they're getting back? How does that work?
Yeah, that's right, exactly. So it's basically like you take you can lend up to 80% of your refund. So say you're expecting $100,000 refunded back from your R&D activity, we can lend you $80,000 and you'll pay interest on that $80,000 when the refund comes back. So when the refund comes back, you'll pay us back the 80,000 plus a bit of interest, and off you go.
Yeah, excellent.
Yeah.
And who is it not for? Like, who's not a good fit
Yeah.
for like non-dilutive funding?
Yeah, so what we need companies to have an entity in Australia or New Zealand. You can have many other entities around the world, but we can only lend to the Australian or New Zealand entity. We need companies to be making at least $50,000 a month in revenue, and on average, our companies are making between sort of $2 and $20 million in revenue per year. So on average, they're doing about a few $100,000 a month, but anywhere from 50,000 up, we can support. And then we sort of look for any other sort of things, like if there's a lot of ATO debt in your balance sheet, if there's other loans and things like that, that's tricky. You don't need to be making a profit, but we do like to see that the unit economics will one day lead to a profit. So
Yes.
as you grow the revenue, the costs aren't growing at the same time, they're sort of stabilizing. So they're the sort of things that we look for, but definitely don't have to be profit making. And most of our companies are not. They're usually reinvesting all the funds into new growth and new opportunities.
Yeah, excellent. And then, Susan, as I mentioned at the start, like, you've kind of dipped into both of these buckets already and also bootstrapped for quite some time with the laundry lady. How do you balance, like, kind of what Jodie kind of just touched on then, like, how do you balance the juggling between, bootstrapping, building like your product, and like continuing to grow revenue, and like switching like from that service to more of a product base? Like, how do you do that?
It's so difficult. So, I mean, I started the business way back in 2012 with zero money to invest in it, and literally just had to grow from our own profits, and just reinvest every dollar back into growth. And so that's why it's been such a slow journey, a really long and windy journey, because we're a very low profit margin business as well. So it's really difficult to invest very much in there. And so, along the way, it has definitely been accessing everything that we could, accessing grants, particularly in the beginning, few years was what kind of got us to the next trajectory along the way. So, we didn't have a platform or anything like that in the beginning. It was just me as the original laundry lady going out and doing the services, and then it was actually a grant which got me to having an off-the-shelf platform integrated into our website, which meant we then had booking. We could then start to bring on contractors for the first time, but even that was almost 10 years ago now. And so we actually built the business all the way to 6 million without taking on any investment, or looking into all of those options. So it's definitely hard when you're trying to take income for yourself as well, and I wasn't able to take a salary for a really long time, which again has meant I've had to go back to work. I've had to make it my side hustle for several years, so it's only really in the last 5 years that we've been able to really invest in the business and start to grow, and like we took on lots of, well before we knew Tractor existed, well before Tractor did exist, we were took on lots of debt as well in the early stages, which again helped us grow, but then you've got to pay that debt back eventually, and so that all of those things like impede on your growth, because the more money you can put into that, you know, the faster you see it. And we now have raised for the finally closed our investment raise, which took again over a year to do. And once we have closed that in the first month, we've already seen our revenue increase by 12% by having money to put into our marketing efforts. So, you know, in some ways it's like, it's very frustrating when you know you can grow faster with more money, but also it does stop you and teach you a lot about your business, and you know, being able to grow slowly, like a tractor pace instead of a rocket pace, means you're you know, learning a lot along the way, that I think, you know, you're not just throwing money out the window, which I think some people do when they have lots of money in the bank. So yeah, bootstrapping definitely teaches you a lot of skills in that area.
Yeah, in terms of like minimizing that burn rate. And I guess
absolutely, every dollar counts, you know, every subscription that you have, every, you know, everything. And, you know, it's a real mindset that you've got to work, you know, to do that, and to manage things at that kind of level. But then, you know, now that there is money in the bank, it's like those same, you know, practices come into effect. We're still counting every dollar and making sure it lasts and all of those things. So yeah, it's definitely good lessons, I think.
Yeah, for sure. And I think like the cool part about like the non-dilutive funding and the grants, like obviously from, you know, Cake's perspective, like we really love to see founders like have as much ownership in their company as they can. So in terms of that equity ownership and that dilution that comes with taking on like venture capital investment, like it really enables founders to retain more of that ownership.
Yeah, absolutely. Like I'm really lucky that I still have 90% of the business, you know, even though we've just raised $1 million. So that's a pretty cool thing. Like, and I probably would have absolutely taken money earlier as well, but would I have done as well with that investment in an earlier stage? I don't know, but you know, and even our round now of that $1 million, some of that is still made up with grants. So we've raised $650 through angel investment, but we also have a $200,000 investment from Advanced Queensland from their Female Founders Co-Investment Fund, and another $160,000 from Export Market Development Grant, which is Australia's EMDG program to help you export into international markets. So yeah, so we've been able to raise with you know, without diluting too much, because I had Jodie in my ear saying don't sell your soul too much.
Oh, I love that. And coming back to you, Caitlin, like we've just Susan's mentioned some really great grants there that she's been successful in applying for. How do you, like, for founders on the call, like I think, you know, like grants can maybe seem like a bit of work. So like which ones, like how do you tell like which ones are going to be kind of like lower effort or easier wins? Like is there any way of hacking that?
Oh, really, I think it comes, I mean, like, yes, on a very like foundational level. So the smaller the amount of money you're going for, the smaller the effort is, the lower kind of application process will be, the kind of easier the reporting process will be. Sometimes there will be a really minimal reporting process. There is always a reporting process. And so I think like, yes, like
When you say reporting
foundationally,
process, do you mean like after you've got the money? Is that what you're meaning?
it depends on the size of the grant. So sometimes it will be a milestone reporting. So you'll have to report at different stages of your project that you applied for, or you will just report at the end. And so you'll get the money, you'll go through, you won't get all the money up front. Usually you'll get like 80 to 90%, and then you'll go through the project process. And at the end, you'll provide them with a final report and you'll get your final milestone of funding. So it just depends on the size of the grant. Literally every answer I'm going to give you will be like, it depends, or like typically, because they're like always different. So yeah, it is a bit of a struggle because like it's always different depending on the size of the grant and also where they're coming from.
Mm-hmm.
But I think it also just makes it easier when you have strategically thought of the direction that you want to go and like how these different pots of money kind of feed into that. So exactly, I mean, like I feel like, you know, Jodie and I kind of both feel like Susan's kind of like this really kind of like pillar of like what everyone should really be looking to do with their business and their strategy and things like that. Because yes, the EMDG grant is great, but are you looking to export, overseas? Like, what is your process? Like, have you really thought about that? Because otherwise, no, it is going to be a waste of time to try and go for it and get that money and kind of answer the questions if you haven't actually thought of like what you want to do ahead of time. So it's really about kind of understanding the strategy of your business, the financial strategy, and how those grants can fit into that. And from my perspective, that is how they become low-hanging fruit and they become easier. Even if you are going for the $200,000 female founders grant, which is a really substantial grant to go for, but it is still like easier to go for if you have considered how that fits into your strategy. And it may be easier than a smaller grant that you haven't really, it doesn't really fit into your strategy. But it's technically easier to go for. Yeah, I hope that makes sense.
Yeah,
Yeah,
for sure.
I would just add to that. I mean, that $200,000, co-investment fund, like, it sounds really lovely now that I can say it in the press release and put it out as part of our round. But and some of because I've complained about it like for a long time. Like, it took a lot of work. It took more work than the actual raise itself to get that funding. And like, there's less than 10 businesses who have got it in Queensland. Like, it's a really, really hard slog. And you also, like, it's taken probably 14 months from when we started that process to now. And also, a lot of the grants you don't get upfront. Like, it's not money in your bank account immediately. Like, something like Tractor, you kind of 3 days of back and forth on your accounts, and then money's funded quite quickly. Like the EMDG, we still won't even see that for 2 years. And so it's, you've got to have all of that in account as well. But I do think it does help you, the whole process of writing the grants, it does help you really, think through what are your strategies and what are you trying to achieve. And once you've done it a couple of times in those grants and you've got that information, and then it's just, rewording it for the next application and all of those things. But it would have taken my marketing manager, who helps me write all of our grants, like, she literally spent 3 or 4 months of her life last year just writing grant applications and also awards applications, because we needed to like build our profile as part of that application process. So it's a ton of work that takes you away from your business. So sometimes it's, you've got to value, is this actually going to help me achieve what I want to do?
Yeah, I think, sorry if I can just add, because I've done a lot of grant applications in my life as well. And one thing that I've got caught up in before is trying to write the grant towards what that grant's looking to fund. And then you end up getting the grant, and then you have to do those things that and I've been caught out. It's like, oh shit, we don't actually want to do that, but now the whole business.
But now we've got
got
the money, we've got to.
Like, so like when we mentioned before, like free money, it's so not free money, because it's like you have to work so hard for that money. Yeah,
totally.
Absolutely.
Really hard.
And that is such a really common mistake, is that people be like, oh, I can get money over here, let's just design something for that grant and we'll get it. And it is such a problem with like mission drift and taking you away from your core business. It really is thinking about it as an investment, non-repayable investment, but there is time and effort that has to go into it, and you have to deliver against what you promised you would do. And if you don't, that does reflect poorly on you when it comes to those businesses, those government departments that then have to kind of deal with that.
Yes.
Interesting. I'd love to know, Jodie, then, like, in terms of, like, we've talked about obviously the grant process of applying, in terms of non-dilutive funding, what is that process? Do I have to put together my pitch deck and do like the dreaded investor pitch? Like,
no, none of that. It's so simple, as Susan alluded to. Like, it's super simple. We have an online form that takes no more than 15 minutes, and then we need to connect into Xero or your accounting platform and just as a read-only access and pull some data out, and then literally we can have money in your account 3 days after that. So it's very light touch. We're understanding the financials, and then often we'll have a call with you after we've had a look and just make sure we've understood it correctly. And that's it. It's pretty light touch.
Yeah, nice. And then Susan, when you have gone on the recent raise, like what do you have any like tips for anyone on the call? I know I believe yours has been an angel raise. Yeah, any tips on like that process and how long that took and
Oh my gosh, I'm going to write a whole book on that process. But yeah, look, I think, first of all, do you actually need investment? Like, I think my first tip would be go out and start getting some revenue first, because, I know that's not like, it depends on your type of business and things like that, but a lot of businesses think they've got to raise before and get their tech and do all these things before they get started, and then get to that point and go, oh, we don't even know who our customers, we don't even have customers, no one wants this product. So, I would say if you can in some way try, and it comes back to that whole minimal viable product, but I think if there's a way you can do that and just start getting out there and doing it before you think about getting investment. I think you should be getting investment by the time you're getting investment, you shouldn't actually need it.
Yeah.
It's really about like boosting your trajectory rather than survival. And some other tips, I guess, is really just understanding who are the type of investors who will be interested in your business. We definitely wasted a lot of time talking to VC, and like Jodie said, they're looking for rocket ships, and like I still think we're a rocket ship, but not in their eyes. And so we definitely, and a lot of them say we're sector agnostic and we do this, and but the reality is they don't, and the reality is they're seeing thousands and thousands of pitches, and they're investing in maybe 10 a year. So you've got to really be the right fit for them. And for us, then it was angel investment was definitely the right place for us. But it took and that's a lot more work too. It's a lot more pitching and all of that. But yeah, I think definitely understanding who are the people who would be investing in you. I mean, I certainly learned a lot along the way in terms of refining my pitch and learning the questions that investors are asking, and and starting to really like think through like the future of the business and how that fits into some of those questions. So it was a really great process in terms of that, but you're also getting a lot of feedback along the way that you have to also be very I think it's kind of, I always say it's like parenting, where you start getting advice from everybody and it gets very confusing and overwhelming, and you've got to, at the end of the day, be able to trust your own gut. And so I think that's, really important when you start getting opinions and ideas and things like that from everybody. Like, at the end of the day, you're the one who's driving the business, why you're doing it, and you've got to come back to that. So yeah, they would be some of my tips, but I could literally talk for hours and hours and hours. And I definitely think if you're in an early stage, going through like an accelerator program is probably the best thing for you to do. I never had access to any of that when I first started. I didn't really have business networks in the beginning. It wasn't until much later that I kind of started to tap into all of those resources. And I think if I had tapped into that much earlier, I could have, built the business in a different way, a lot faster, and got off the roller coaster of loops a bit earlier.
Yeah, excellent. It's such a process in terms of going through that. In terms of the raise, how long has that taken?
Well, it has really taken a full year. I think, Jodie, I met you at TIFF last year in June. I think that was really like the starting point of that, and we've just announced the raise in July. So yeah, it was just over a year to take. So and I was definitely ready to give up along the way. And there's a lot of people who will breadcrumb you along the way, which just takes up more time because they're saying, yes, we're interested, just wait for us, and they're not really, and all of those sorts of things. And I think, again, like, that's been a big learning for me, is just really, like, if you're not interested right now, if you're not going to give me an answer right now, walking away, and not, but it's about building the confidence within that space as well. So, it's definitely like getting those relationships along the way. Like, I didn't know any VCs or investors or anything before I began. And when I went to TIFF in June last year, like, that was my first introduction to investors. And that was a really great, safe space to do that, because you're out on a boat out on the reef meeting investors. They can't get away from you, but you start to realize that they're real people, and
sales are now through the roof.
Yeah. But like they have their own mandates that they're trying to reach as well, and I think trying to understand that rather than because the no or the feedback that you get, it's often not about you, it's about them and what they're trying to do. So I think understanding that will give you more confidence in yourself and your business as well. But yeah, it was a definitely selling my soul kind of process to go along. And I think we'll probably be raising again before we know it. So, but I think next time it will be easier because I know so much more than I did the first time. So yeah, it's definitely a big learning curve. And I would say if I'd have done it earlier in the business, I probably wouldn't have survived that process, and I wouldn't have known, I would have been steered in the wrong directions, and I would have had no idea really how to pitch the business the way that I can now. So, I think it's about all of these sources of funding. I think it's about finding the right time for each of them. Investment might be really right for you, but it might not be right now. Whereas, getting venture debt might be, right now, or accessing grants, it could be. So it's, all of those things have a place, but it's just finding them at the right time.
Yeah, for sure. Jodie, I feel like you probably have like a wealth of knowledge in that space as well, in terms of like raising and knowing like about timing. Is there anything that you can add to those?
Yeah, I mean, I think I feel for you, Susan. Like, just reading between all of that, like, God, I'm sure you have a whole lot of horrible experiences. And I do think that is something, there's a few things in there. I do think that the playbook is, wake up one day, decide I'm an entrepreneur and I've got a startup. Therefore, I must pick up the book that says go get VC funding to validate myself as a proper startup. And so that's one of my jobs, is to try to rewrite that playbook a little bit. And, Susan, you do a fantastic job of like explaining all the other ways of actually building a solid business. And the trade-off is, of course, speed. But, when you've got a solid business, then, that's a great foundation. So there's that element. And then the other element I think that people do calculate is, how time consuming it is. And there are a lot of VCs, and there's more and more funds that are popping up, and they all will give you a meeting. There's no doubt you'll get a meeting with every single investor in this country, because no one wants to miss the next camper. But, as Susan pointed out, like sometimes they won't respect your time. And so there is, like, I've talked to founders over the years where if they would have just spent that time getting more enterprise customers, they would have ended up with more money in their bank account than all the time they spent trying to get investors and failing. And so it is really like that, the opportunity cost you have to consider, and the time that it takes. I think a lot of founders still think that equity funding is free, and it's certainly not. It's very,
yeah. I mean, the time thing, like I have dedicated my everything to this raise, like that whole year. I mean, like Jodie, why are you at this another event? You're everywhere. Because I just wanted to make sure that I was out at every event and meeting every investor and doing all of those things. But that meant I was completely away from the business really for that whole year, and I'm really lucky that I have a team behind me now. Like, it's not just me doing the work and doing all of everything at the moment. And I have an operations manager who started just before I started that process of the raise, which means I just have confidence that my team are running the business and running it well, and they don't need me there on that daily basis. But if I didn't have that, like, it would have really impacted the business, because it did take absolutely every ounce of my time to do and focus on.
Yeah, and then of course you do need to pay those investors back, right? They want a return. And we've done some maths about, if you compare the return that an angel investor wants as if it was a loan, then they'd be looking for 400% per annum in interest. That's the kind of expectation they have on the return on their money, right? And so it's a lot higher than 10% simple interest.
For sure. I feel like we've covered like that. Obviously, like, running a raise takes a lot of time. Grant processes, applications can take a lot of time. I want to pop back to you, Caitlin, with another question of like, how will a founder know like when to DIY the grant application versus, engage someone like yourself that helps people write them?
Oh my God, I really don't want to like lean on my like it
Depends.
depends like little catchphrase, but no, I think if so my general rule is like if it's under $5,000, please don't worry about me. Um, and so I do think like that is a pretty good rule, but I would also say a lot of people actually come to me and they'll be like, I have this grant, I want to set up a meeting, I want you to write it for me. And then like we'll get into the grant and I'll be like, do you really need money for this? Do you really like, is this going to help your business? Like, how can you tell me how it's going to help your business? Because that is like a big part of grants, is like demonstrating like how this money is going to contribute to the sustainability and longevity of your business. Because the return on investment for most startup grants is jobs and contribution to the economy. And so I think where it's really good to engage someone is if you're feeling like quite lost around what you need money for and what's going to kind of really contribute to your business, because often those conversations where they've kind of asked me to talk to like they want to talk about a specific grant kind of morph into more of a strategy conversation, and it's more like, is this really going to be helpful? Like some of them have it down and they're like, yep, this totally makes sense. But if you can't answer those questions, I think that's where it's really good to engage someone who is an expert who can kind of like help kind of guide you in the right direction. I would say also that depends, because there are people who are very straightforward grant writing experts. They cannot help you on strategy. So it's also making sure you're working with the right person, because that really is a space that I've worked in for a long time. And I have, kind of similarly to ladies on this call, been in the startup sector for a long time in Queensland. And so I can help answer those questions. But yes, if you're looking for a very straightforward answer, I would say really anything above kind of like the 10K mark and anything that is requiring a lot more kind of strategic thinking, as opposed to, I need a piece of equipment.
Mm-hmm. Yeah, for sure. And then in terms of that, like when they do engage someone, like is there any sort of follow-up on that you can hint at? Is like, how do you tell like who's the real deal that's going to actually help you and who's just gonna like take you for a bit of a ride?
Oh, that's a good question. I don't know if I
I didn't
know,
put that on the
because
prep list, so
no,
sorry.
no, it's fine. No, I think because obviously I am the real deal, just FYI.
Obviously. Otherwise I wouldn't have invited you.
No, I think it's really interesting because I do have conversations with people that are like, oh, my grant writer wasn't successful, blah, blah, blah. I'm really cognizant of people who shout about their success rate too much. And that's why I often don't like mentioning my own success rate, because it isn't necessarily like real. It's not really grounded in kind of fact, because your success rate isn't necessarily based on your quality of writing. It's based on a number of political factors. What are the types of businesses that these kind of granting organizations want to invest in? It's not just tied to kind of the grant writing kind of prowess that anyone has. So I'd probably be a little bit cognizant of people who are kind of like, oh, I have a, kind of like 100% success rate or whatever. And because yeah, I would probably be like, is that real? Like what kind of goes into that? What's the actual kind of data behind that? And then if if I guess they aren't able to kind of like, demonstrate people that they've worked with previously. And, I myself always find it very strange if people don't have like an online presence. So, if it is really hard to find a website, a LinkedIn profile, that kind of stuff, that's like pretty basic. But like, I'm always like, I know like on being online isn't great, but it's also like a way that we kind of start to verify, the connections people have and kind of whether they are beneficial, and kind of just getting those word of mouth references as well. So if I have someone comes to me with a grant that I can't do or won't do, I do not do research grants. I think they're one of the most horrible things ever designed in the history of grants. And so they're just not my bag. And so I have people that I will refer people to. So also having that really nice community of grant writers, like in my community of grant writers, we aren't competitors, we are friends, and we work together. So anyone who kind of like positions themselves as like, against other people. I'm always quite wary of that as well, because I'm like, we're all here to support each other. And if you're doing a good job, you'll always have a customer base.
Yeah.
I would just add to that on the other side of that, like absolutely anyone who says they're going to get you the grant, run from them, because we have applied for a lot of grants, and I have to say there is definitely some that we have not got that, and that doesn't come down to our grant writing. Like, our grants were excellent, we definitely fit the eligibility, all of those things, but some of them are just very oversubscribed, and no matter how good your grant is, you're not going to get through that. And sometimes the type of business you are does really impact that. We've just had some that have said no to us, that it was very much about the type of business we are. And and again, I think that comes down to, you've got to build relationships sometimes in those government departments, particularly when you get to the bigger grants, because that will help you drive through that. And also, if you do get a no on a grant, always ask for feedback. Not every program will give it, but quite a lot do. And even if it's just one line of feedback, which you might read and go, what does that mean? Like, it's still something, so that that can help you for next time. So definitely do that.
Yeah, I love that. I'm going to ask one more question to you, Susan, and then we do have a question in the Q&A box, and then I'm going to throw to the audience. If you do have questions, pop them in the chat or in the Q&A section. So my last question that I've been thinking about, Susan, I know obviously as a founder, and Jodie, maybe you can share some on this as well. Like, if you're sitting in that breadwinner seat for at home, and how do you balance that juggle of founder life plus surviving at home? Like, do you have anything in that space you can share?
Yeah, it's really hard for sure. And again, why my journey took so long was that I got divorced and became a single mum, and I had to go back to work. And the Laundry Lady became very much a side hustle. So I went from doing the laundry to back to work, side hustle, had some contractors. And in those years, I really didn't know how I was going to come back to the business, because I couldn't leave the income. I needed the income to be able to survive, to feed my kids. And trying to balance that. And so it literally was, I'd be driving to work in my 45-minute commute and be on the phone doing recruitment interviews for contractors. And I'd be spending, 3 hours on a Monday night doing my AdWords and paying my contractors and doing all of those things. And, that's a hard grind if you are doing that. But I know lots of people, that's their reality. It's wonderful if you don't need to do that, if you don't have kids yet, or if you've got a partner who's paying some of the bills. But I didn't have any of those things. I just had to keep it going. And it's really hard, I think, when you're going through that period, because you think, and what am I doing this for? Which I did often think, but I had lots of reasons that kept me going, particularly the people that we're supporting. And for me, it was actually when COVID hit, that was the opportunity for me to come back to the business full time, because I had lost my events job, and it was literally now or never. And I just thought, I've just got to go really hard for the next 6 months and get it to a place where I can get an income and survive. I think it took me about an extra 2 years to actually be able to take an income and to take that income regularly. And again, that's really tough in terms of if you need to access finance in any kind of way in your life, like a credit card or a home loan or anything like that, pretty much write that off, because until you have a regular income for at least 2 years, and even then everything in the business impacts you. So I still find it really hard to, even though I've got a business that's turning over almost 10 million in revenue, I still find it hard to access any kind of loans and things like that. But so I don't know what the actual answer is to how you do that, but I think it's just perseverance and trying to manage your money through that process, and knowing that it's going to be tough at the beginning regardless of what your situation is. And I think that's a question that people have to ask themselves of, do I actually want to have a business, or should I just go and have a job? Because sometimes that could be a better answer for you as well, because it's a long journey, and it's not like you're going to be on the rich list in the first few years.
All right. And then I've popped up all your links to your different websites and your LinkedIn profiles, and I'll throw to the first question, and this is like open, anyone who wants to jump in and answer. So the question is, what funding pathways would you recommend prioritizing if you're looking to get a business off the ground, e.g., cover development, inventory, and pre-revenue?
I'll jump in. I think when you're pre-revenue, then I think you need to find those kind of early believers, like those angel investors that have a real strong connection to what the problem you're trying to solve. It's crowdfunding could also be an option, but the non-dilutive or debt options don't come into play until you have revenue.
And I would add, in terms of like if you're looking for grants, it is difficult to get grants that are going to pay yourself. They are typically to pay other people to support your business. Maybe it's like getting a web developer, maybe it's getting a consultant in. So it is thinking like quite early on, at what points do you need what kind of support, and kind of doing a bit of research around the cyclical grants that can really help you with that scaffolding, because they are typically quite cyclical. And so governments will put them out every 6 months, every 12 months. And so looking at kind of how they can kind of support you in that really early stage.
Excellent. And then the next question for Jodie. What's the one mistake you see early stage female-led businesses make time and time again?
Oh, I think it is that sort of thinking that you need to go and get investment. And I think Susan really showed the pain of that, and probably didn't talk to a lot of the bias that she would have come across. But yeah, it's even harder for us to raise money. And so I think you need to just be really strategic about it, and probably just very, very ruthless on your time and who you talk to. And so I talk to female founders a lot, and my thing usually is like, and where I've seen it really work is when you can find, like one woman I mentored early on who started a bathhouse. They raised $1 million around COVID time. I think they were actually opening it, and that's a bathhouse. So there's nothing scalable or rocket ship about that. But they managed to find some really amazing investors who just really believed in what they were doing. That sort of that wellness space and them as people, and they really had to lift up the floorboards to find these investors. But when you do find the ones that really believe passionately in what you're doing, and like it might be that it's their own personal story that resonates with it. I just think that you need to kind of really think about and do your research on who those people might be, rather than going around and being shopped around the whole market and wasting a lot of time.
Yeah, and I think to put a cake lens on that, Jodie, like what do you see like in terms of like looking at your deal terms and things like that when you are actually like looking at taking that investment? And then like any tips on around like valuations and like the dilution piece and those sorts of things?
Yeah. So like definitely you want to dilute as little as possible in the early stages, like less than 10% if you can, because if you're on that path, then, and I was totally this when I was raising for my first company, or trying to, like all I could think about was the seed round. I didn't even think about what happened after that. All I wanted to do is get the seed round done and get that investment in. And so I probably, if I had been successful, would have sold 30% of the company. But what I now know is that that's very dangerous, because you're going to again and again and again and again. And you don't want to get to the point where finally this thing is about to take off in the US and you're about to talk to US VCs, but you only own less than 10% of the company, because they will not touch you based on that alone, because you just don't have enough skin left in the game to drive you to that NASDAQ or wherever you're trying to get that billion-dollar, multi-billion-dollar mark that they will want you to get to. So just it's very important to be mindful of all the dilution along the way if you're going on that path.
Yeah, for sure. I've just popped in the chat. We have some free calculating tools on our website for cake around dilution, and also just around like compensation packages for teams. Within the platform itself, it does have some more robust calculating and modeling capacity, but those ones that I've linked there are just our open source ones. The next question we have is a question that says, for founders building real profitable businesses that happen to be service heavy, how do you compete for attention in a market that seems obsessed with tech-enabled everything? For example, if grants and investors are looking for technology/innovation, do you reframe your responses?
Yeah, this has definitely been a space that has been hard for us in the investment raise because like VC are looking for a B2B SaaS product. Like it's heavily invested in tech. Everything is very heavily invested in tech, and we primarily are a service business. We provide a laundry service, and so we've had to really spend a lot of time in the last year reframing how we talk about the business. And again, I think this comes back to the last question about mistakes that females make, because I think we that's what we do. We pitch the story behind it and we pitch our passion behind it, whereas investors are just want to know, is it tech driven, how's the tech going to scale, all of those kinds of things. So we've had to really work a lot around our narrative, and because we have tech, it does drive our business, but it's not the primary story of what we're doing. But we've had to really change that narrative, particularly depending on who we were pitching to and how we were selling that story. So and for some of the government grants as well, have also been very focused on that, and that's where we've had some no's, because they don't love a service business, even though it's got really great traction and doing 10 million in revenue. That's not enough to kind of convince them of that story. So so I think you have to really think about that part of the story as well, and if that's the type of investment that you're looking for.
Yeah, and I would certainly say that a lot of grants will use the term innovation. They don't, yes, they use innovation all the time. They don't actually necessarily mean technology-enabled innovation. So it's about kind of looking at the grant in terms of like, what is this is obviously specific to grants, what is the outcome they're looking for? So for example, at St John Ambulance Queensland, we do innovative work around how we connect socially isolated seniors and kind of improve well-being in socially isolated seniors. It is definitely not technology enabled, but it is innovative. And so it's about looking at like the definition of innovative and how that applies to kind of what you're pitching and kind of connecting those two pieces. Obviously, if it explicitly says technology enabled innovation and you don't fit into that, that is excluding, kind of just look at something else. But if they're just using the term innovative, that's a very different thing. And it's about kind of just demonstrating how you are innovative and how you are doing something different to other people. So it's just
which
semantics.
we had some big knockbacks on grants particularly around the word innovation, and that they thought we weren't innovative enough. And it didn't mention tech at all, but still that was really what they wanted to hear in their answers, because we are an innovative business. We've created a business model that doesn't exist, and I think we were very strong on that in our answers. But still, and I think sometimes you got to remember, like the government people who are doing these grants, like they need it to be, they've got a very strict criteria that they've got to tick off, and so you've got to really get it into the language that works for them. And again, I think that comes back to having some relationships with those departments, and so that you know what that's going to look like, or using someone like you, Caitlin, who knows, who might have some insight into it. But that's a really tough space around the innovation space to try and convince if you are not specifically tech, is what our experience has been.
I am conscious of time, and please do jump off if you need to, but I have one last quick little burning question. Jodie, you mentioned earlier around when you've applied for a grant and then you're like, oh God, I've got to actually do the thing that I said I was going to do, that I pitched it in. I mean, it's not off the record because it's recorded, but between you and Caitlin, what happens if you don't do the thing that you said you were going to do in the grant?
Well, I don't know, because I just did it, but it was painful. It was
to give the money
and it was
back.
off mission. And that's when I realized, oh my God, I shouldn't have been, I'm not here to work for the government.
Yes. So in the worst case scenario, you will have to give the money back. So government it's very hard for government. It's a very long process for them to take the money back. It can be really hard. So they will work with you to, I guess, like develop a solution that fits both of them without giving the money back. Definitely worst case scenario is giving the money back. And I have heard of that happening. But yes, typically they will work with you for a solution. However, it is very unlikely that you will get funding from them again in the future because you will be seen as
Blacklisted.
unreliable. Because a lot of developing grants and tenders are really about building trust and safety, and that you will deliver what you said you would deliver, and you have that capability and capacity. So if you've immediately proven you can't do any of those things, they'll just be like, it's highly unlikely you would get one in the future, unless, kind of like Susan said, you have those relationships, you've explained off the record why it didn't work out, and they kind of have that kind of understanding of, maybe because COVID, great example of how a lot of people had to change substantially grants that they had applied for. And so there are extenuating circumstances, but yes, worst case scenario, you have to pay it back. And then, it's highly likely you've damaged relationships.
And I think like going in and talking to them about it early in the process too is really important. Like we just got the EMDG Export Market Development Grant, and we had applied for US and Canada, and we've since decided that we're not ready for US in its current environment. So we're parking that, and we want to do Canada and UK. And so, we had to go back and ask them if we could change that market. And that meant, resubmitting a market plan and all of those kinds of things. But, working with them early so that you can do that early, I think is, like they've agreed to that now. So that's great. But, if we'd have waited till the end of 2 years, we would have been in trouble if we hadn't have, talked to them about that upfront.
Yeah, excellent. All right, well, we've gone 1 minute over, so we should probably wrap it here. Yeah, hopefully everyone's had a chance to scan those QR codes, connect with Caitlin, Jodie, and Susan on LinkedIn. Yeah, Caitlin has a really wonderful newsletter, so if you want to subscribe to that, that has like tons of like cool grant tips within it. And then I've also linked Tractor and the Laundry Lady websites. So thank you, all three of you, for your time. I've really enjoyed this conversation, and I have no doubt the audience have got some great value. So thanks, everyone.
Thanks so much.
Thanks for organizing it, Tila. This is so much fun.
I loved it. Okay. Bye.
Bye.